Now, my next guest has been extremely overweight and bullish on tech. So is he looking to move? Let's bring in Rob Luna, Wealth Academy founder Rob Luna. Rob, you cashing in your tech positions?
Well, Charles, I'm still very, very bullish on tech, but I think, I have to agree with Omarosa. I think if you've been on that one side of the boat, heavily weighted to tech, it's not a bad time to take a little bit off the table. When you look at days like yesterday, you can kind of see when that tide goes out where the empty spots are. Small cap stocks, some of the dividend paying stocks. It's probably time to take just a little bit off the table and start nibbling on some of those names.
Though, I find it interesting because this conversation could have been had for almost periodically
Absolutely.
throughout the year, right? And every now and then the small caps will have a pretty good day or a pretty good week, and then bam, just like that, because it feels like that these mega cap names, particularly the Magnificent Seven, became the de facto defensive place to be.
Yeah, I agree. When you look at them, they have pristine balance sheets. A lot of them are in areas like AI that are growing extremely rapidly. So that's what I'm saying. You look at the names like NVIDIA and Amazon and Google, definitely do not get out of those. But if you started buying those positions like most of us were a couple of years ago, it's probably such a large part of your portfolio. It doesn't hurt to trim a little bit right here. And I think what the difference is when you look at these inflation numbers, by no means does anybody think there's not going to be at least one rate cut this year. So I think, if anything, it's coming pretty soon. These names are extreme laggards. Right. I think if you've got a year, 2 years, you're not going to really get hurt by at least dipping a toe in the water and buying some of these small cap names. And look, you don't have to buy the index. Look at some of the growth names in the small cap area.
Well, I know you like HIMS, right? That's one name that you do like. The stock.
Yeah, I like HIMS and hers. That stock, I think, look, they just got approved to do weight loss now. We know all the other things that they're doing. It came public as a SPAC. It's doing really well. I think that stock's got 25 to 30% upside. I think that's a good individual name that you can play. I do want to caution people, though, about buying these ETFs for small caps. A lot of those small cap ETFs are heavily weighted towards regional banks, and I see a lot of those with heavy exposure to commercial real estate, and I think that shoe is still going to be dropping. Right. Do not get overweighted to small regional banks right here. Look at what those ETFs own.
And Anastasia also alluded to the fact that they don't do well. 40% are in the Russell not even making a profit. I did want to say with HIMS and hers, though, there was this report people are wondering where are they getting their weight loss drugs from, sort of, like in the Bronx, is it falling off the back of a truck? But let me move on, because you say you want everyone to have duration. I hear people use the term duration, and it feels like it means different things to different folks. What does it mean for you?
It does. Well, look, when you're investing, we're all investing for a reason. It's either one or two things. Long-term growth, because we need that money later on for something, and that's why we're in tech and small caps, or we need income now. And income now at a time until this last year, 2 years. And that's the benefit for people like retirees. When these rates go up, you can get some income. Now, the longer you go out, meaning if you buy a 30-year bond, you're going to get a higher rate than a 2-year bond. So what I'm saying about duration is buy those longer dated assets, those slow, stodgy stocks with the high yield, things that you can lock in interest rates for a long period of time, because if rates come back down, you don't want to have to be stuck refinancing or getting into some of these rates, rolling your bonds. Even though short-term bonds are 5 right now, they might only be 1 or 2 in a year or 2 years from now. So when you can get 5 or 6% now, especially if you're a retiree, lock in some of those rates for the long term.
Hey, Rob, before I let you go now, but only got 30 seconds, your biggest concern is gnawing at you the most.
Well, I wish I knew what was going on with this election. We don't even know who the candidate's going to be. The candidate doesn't even know who he's going to be. So I think, right now, Charles, we're going to need a little bit of clarity around that. I think there could be some bombshells that get dropped. And we all know the markets hate uncertainty. And so what we're trying to do is kind of figure out who's going to be the next leader of this country. And that's going to probably dictate some of the investments we make. So, what happens between now and the next, month or 2 months in Washington is probably my largest concern.
All right. Well, everyone's watching that for sure. In the market, out the market. Rob, thanks a lot, my friend. Have a great weekend.
Yeah, you too. Thanks, Charles.